All right, the risks and the rewards of more quantitative easing. Here to explain possible moves by central bankers, we've got Ward McCarthy, chief financial economist at Jefferies and Company, and he's also a Bloomberg best economist, ranked one of the most accurate forecasters. Good to have you with us, Ward. Thanks for coming in.
It's good to be here.
All right, so you listened to the testimony.
I did indeed.
You digested the initial jobless claims report. You listened to what was going on in Europe, Spain. They sold some government debt today. What do you think central bankers around the world are thinking?
Well, they probably took a deep breath today because they got through another day without a major cataclysm. And I think that what they're trying to do is assess really what they need to do next. In the Fed's case, I should say, they're looking at an economy that's getting a little bit softer and could probably use a little bit more gas in the tank. But their bigger worry is what's happening in Europe, how it could affect the U.S., and down the road a little bit, the fiscal cliff that Chairman Bernanke has mentioned on a number of occasions this year.
We'll talk about the fiscal cliff in just a moment. I'm glad you mentioned the idea of gas in the tank. Gasoline prices are down. Crude oil prices are down. Doesn't that give a little fillip to the economy?
Well, I think it helps the consumers in a couple of ways. First of all, consumer sentiment tends to correlate with gasoline prices. When they go up, sentiment goes down and vice versa. So I think there's probably a little bit of help on the psychological side there. But also, to consumers who are pretty strapped from a financial standpoint, the lower gasoline prices give them a little leeway to spend more money on something else. So yes, I do think that's going to help out here.
All right, so good for the U.S. economy.
Good for the U.S. economy.
All right, now if you take that and you mix in a little of the economic reports that we've gotten, whether they be housing last week or indeed, as I said, we're looking at the trade deficit. We've got those coming out tomorrow. Does the Federal Reserve look at the U.S. economy and say, gee, we need to do more because something's wrong in the U.S. or because of global concerns?
Well, I think the next thing they do is because they're concerned about what's happening in the U.S. When you look at the Fed's objectives, they have a dual mandate. They're supposed to try to pursue maximum employment and also moderate inflation, which now is defined as being 2% on the PCE deflator. So here we are, almost 3 years into a recovery. The Fed is below their inflation target right now, and they're well above any reasonable estimate of what full employment is. So just from looking at the dual mandate standpoint, it would argue that the Fed should provide some accommodation. And that is exactly what some of the policymakers on the FOMC have been saying recently.
Federal Reserve President and the Bank of San Francisco coming out today and saying that maybe the Federal Reserve can be a little bit more accommodative. Would it work at this point if the Federal Reserve really did anything?
Well, there are diminishing returns to what they do with their balance sheet. And I think that what they're considering is that in order just to put a little gas in the U.S. tank, that they'll do some kind of a modified version of Operation Twist and extend it. For example, this time instead of buying just treasuries, they'll buy a combination of mortgage-backed securities and long-term treasuries. Probably something similar in size to what they've done before. In terms of the specific numbers, we think about $300 billion on mortgage-backed securities and about $115 billion in 30-year bonds. For the bigger risks, which relate to Europe and which relate to the fiscal cliff, I think the Fed would prefer to save a QE for that type of situation because that's the heavier ammunition, and they want to make sure that they have something left over for a bigger, more critical type of situation.
What would buying more mortgage-backed securities ultimately do for the economy? Aren't mortgage rates already low? I mean, is this just a signal to investors? Go ahead, front-run the Fed because the prices of those securities will go up. How much lower can yields go?
Well, I don't think yields can go a whole lot lower. What would be accomplished if they buy mortgage-backed securities is that they could probably cause mortgage spreads to tighten, so mortgage rates would go a little bit lower. People who have refinanced before could probably refinance at lower rates. And anyone who is getting into the mortgage market for the first time could get in at an extremely low rate. So on the margin, that would help. But the bigger problem in the housing market is that credit is pretty tight, and it's very difficult for people to get mortgages right now, and that's not really going to help on that front. So the other possibility is that if the mortgage originators know there's going to be a willing buyer of mortgages, they might be willing to loosen up their standards a little bit and originate a little bit more. But it's not going to have a big impact, in my opinion.
What is the fiscal cliff?
Fiscal cliff is the consequence of the inability of the people we elect to run the country to run the country. And basically it's the two things that are going to happen at the same time. If you recall, after the downgrade, Congress ended up with an agreement where they would sequestration that would reduce spending from projected spending levels over a 10-period time horizon. And the first of those spending reductions will take place next year. However, also we have had a series of tax cuts that go all the way back to 2001, 2003, and then also the Obama administration, all of which expire on December 31st of this year. And if they are not extended, we will get a tax hike of as much as $1 trillion, actually more than $1 trillion, over an 18-month time horizon. And in my opinion, that would bring the economy right back into a recession. And if it looks like they're going to go to the last minute, I'm afraid that it's going to cause businesses to delay expansionary decisions, delay hiring decisions, so it could even take a bite out of growth this year before it even happens.
Sounds like it could also ruin your New Year's Eve celebration.
That's quite possible.
As Ward was just outlining, the fiscal cliff is a confluence of events. Sequestration, which are basically automatic cuts that would happen without any vote that takes place, plus the expiration of various tax cuts. How big a deal is the fiscal cliff?
It's a huge deal. I mean, if you just look at what Chairman Bernanke said today, if there was one takeaway from his testimony today, I think it was a very simple sentence, which was, the fiscal cliff is a huge deal for the economy in 2013. It's unavoidable. Something that I think Ward said earlier today in an interview, which is in the next 18 months, that's $1 trillion. So we're talking about fiscal implications for $1 trillion.
$1 trillion out of an economy in the United States that's a little bit more than 15 trillion.
That's right. And if you look at what the CBO is forecasting,
the Congressional Budget Office.
That's right. So forget about what SocGen thinks or Jefferies thinks. Let's just go to the lowest common denominator, the government, what they think. If current law, which is the fiscal cliff without any type of political changes to it, takes place in 2013, we're looking at a GDP of 0.5%, half of 1%. Not a good scenario to be in.
Ward, the economy and the election. Do you think that there is a connection between who's in the White House in November, the day after that Tuesday election, and the fiscal cliff?
Well, I think there's a connection between the economy and who's in the White House the day after the election. I think that, unfortunately, I think the fact that we have an election is going to make it more difficult for the politicians to address the fiscal cliff, because the budget is become one of the primary issues in the campaign. Now, recently, we've had some very interesting developments. John Boehner has said the House is going to vote on extending all tax cuts in July and that it will pass. President Obama says that he will not sign anything that extends the tax cuts for the most upper income people. And Bill Clinton has come out and said they should extend all the tax cuts. So it's a really hot potato of a political issue. And unfortunately, I think that complicates things and could make it more difficult to do the right thing, which of course is to extend all the tax cuts, at least temporarily, where they can work out a deal.
Jeremy Hill, I want to give you the chance. What do you think about the election and its influence on negotiating the fiscal cliff? Maybe talk us down from that ledge.
Well, you know, what is interesting from running a research department is the fact that we look at quantitative models, we look at fundamental analysis, but when you're forecasting politics, it is literally the wildest of wild cards. It's very difficult to have a substantial view on whether the Republicans are going to get their way or the Democrats are going to get their way, or there's going to be a grand compromise. The one thing that I think the market misses right now is the fact that we have a tremendous amount of friction between both the Democrats and the Republicans. If you just look at history, lots of commentators that are far smarter than me, the commentators that are in the political arena, think that we are in a time frame where both parties are really at each other's throat. What does that mean? That means by default, it may be harder for a compromise to come through. in the next several months that would help the fiscal cliff and the fiscal drag on GDP going forward.
Ward, how do we have a fiscal cliff that's, as you just both described, about $1 trillion, and yet 10-year government interest rates are 1.6%? Is that realistic? Is that, I mean, how do you square that number with the fact that, as you just described it, we could be facing New Year's Eve going into 2013, and we could be driving off a $1 trillion cliff?
Well, first of all, I think that interest rates, the 10-year note, for example, are where they are now for a variety of reasons. First of all, the U.S. economy has slowed. Also, in recent months, we've seen a very significant intensification of disinflationary pressures, which also tends to help interest rates go lower. And of course, we have the Fed with the Operation Twist. And the cumulative effects of that really change the underlying market technicals and help cause interest rates to fall as well. Plus, the other point I want to...
Can we just use the word manipulation? Would that work?
Well, that's not a bad description.
Okay.
I mean, that's clearly what the Fed wants to happen, which is why they're buying these securities. Plus, if we do go off the fiscal cliff, what's going to happen? The economy, in my opinion, will probably even do worse than what the CBO says. I think we'd be in an outright recession. So that would mean that we'd have inflation would follow suit as well. So all of these things point to lower interest rates. If we did go off the fiscal cliff, oddly enough, would probably reduce the possibility of us getting another downgrade as well. So there are a lot of very strange dynamics that are associated with this whole process and this event.
So, Jeremy, when you meet with clients and they want to know what's going to happen in the next 3 quarters, what do you say? You throw up your hands and say, go ask the guys in Washington?
Well, I mean, that is one way of doing it, right? But clearly we do have a view on this. I mean, our view is that, and our economics department is forecasting that we are going to have additional QE, and the most likely time frame for that is going to be the June 20th meeting, and if it's not the June 20th meeting, it's the following end of July meeting, July 31st, August 1st meeting.
Does Ben Bernanke get involved in election year politics?
Well, that's the reason why the time frame for doing an additional QE is probably limited to the July meeting. Beyond that, I don't think it's possible. So that might ameliorate some of the potential market pain that we are up for if fiscal cliff is implemented under current law.
I want to thank you both very much. Jeremy Hill joining us from Societe Generale, Ward McCarthy from Jefferies and Company.